mode.
Hey everybody, Preston Brent here with our weekly roundup. This is brought to you by our trader user group. This is for the trading week ending July 27th, 2018. Interesting week. We've seen some very strong earnings come in. Of course, we can take Facebook out of that equation. They gave up, I think I read they gave up more market cap in one day than any company in the history of the markets. It was over $119 billion. Market cap they just walked away from. I think Zuckerberg lost about 15, 18, 19 billion in one day as well. So I guess he's left with about 54 billion in his pocket. We also saw the US GDP on Friday come in at 4.1%. So excuse me, that's given us the strongest GDP number print in over 4 years. And we've seen trade tensions ease a little bit with Europe as Trump met with Juncker on Wednesday and they agreed to work on a no tariff trade deal. We'll see how that works out, excuse me, over time. But all of these things move to give the markets a fairly steady upbeat mode. The Dow, however, finished the week. It was up about 1.57%. It was up the most just because we had such good trade tariff issues. That's been the big overhang for the Dow Jones Industrials. So it was up about 1.57%. It was up the prior week just barely by 20 basis points. So it's 2 weeks in a row we've seen nice action here from the Dow. The S&P also was up, not by too much, about excuse me, 61 basis points. And the S&P was also up the prior week about 2 basis points, so essentially flat. So the S&P is still I got something stuck in my throat, guys. So the S&P also finished up. Now the Nasdaq was the lone disappointment. It's been down 2 weeks in the row. 2 weeks ago it was down about 7 basis points, so about flat like the S&P, but this week it was down over 1%. I think Facebook took a big chunk out of the NASDAQ technology sector. The technology sector didn't really have a good week. Now, we've seen a number of high-tech stocks come in with earnings. We've seen Google, Microsoft, and Amazon all beat on their earnings, while we saw Netflix, Facebook, of course, and Twitter. Twitter on Friday got beat up pretty bad as well. So it's kind of half and half for some of the big hard-charging tech stocks. And then next Tuesday, we get Apple. So that'll round out the big tech. We're batting 50-50 on this. We'll see where Apple comes in on the earnings scale, but not enough to really do much damage in the market. You can see I've got on the screen here the S&P 500 E-mini futures. Now, as I've been pointing out to our members over and over again, probably since June of this year, you can see here, right in this area here, I had our members get long the markets. And I said, we're going to come back up into what at that time was the R1 zone, the first level of resistance. And sure enough, that's exactly where we came. You can see we were there for a couple of days there, 3 days there. We spent almost a week and a half in that R1 zone there in early June. And then after this sell-off and the hold here, we got a good signal to go long, and away we went. And then we spent about a week here. We had the typical bust out move and a typical retest. The retest passed, and then we came up here and made new highs with the exception of what we did back here in January. And then we had the the rough day on Friday where the markets kind of came back down. We did a little bit of a retest again. Remember, any technical level, whether it's a resistance level or a support level that's retested as often as this R1 level is here, which really runs a little bit beyond 2,800 down to about 2,785 area, is going to be just a magnet for price action until we get the all clear signal. The fact, though, that we did have a clean breakout does suggest the markets do want to take out the January highs of 2878.50. That's what I'm looking at right now. Should we pull back and this momentum from Friday continue and take us back into this R1 zone? I do not see at this time any reason why we would have much more of a downdrift. And if we do, that downdrift is simply going to be an opportunity to buy the dip at this point in time. Okay, that's the way the markets are playing out for us right now, and that's the way we're traded. I mean, as you guys know, we trade the price action regardless of what we see and regardless of what we hear from the talking heads on TV, because price action is where the action is. It just reflects the combined fear and greed of every potential buyer of the market. So right now, it does seem to indicate that momentum on Friday pulled us back, but it's just a simple retest. Okay, I'm not seeing any divergences in the MACD. If we come over and we look at the RSI over here, the relative strength, I'm not seeing much of a divergence in any of this as well. We're still above the 50 line. So again, we're a buy the dip. Okay, for our members, I'll go through in tomorrow night's weekly market watch for the upcoming trading week, what we would look at as a potential buy trigger. Now, of course, we don't try and guess and buy now and go long. That would be foolish. We want market action to tell us that we should buy. And it's not telling us that we should buy now. In fact, it's telling us that we should just increase our hedge just a little bit to the downside. But that's about it. The other thing that caught my eye is if we look at NASDAQ here. Now, NASDAQ suffered because of the FANG stocks. It was down a pretty good bit on Friday. I mean, look at that. That is and let me just adjust this here. So we were on Thursday, we made new all-time highs. So that's multiple new all-time highs here, okay? And if I connect the dots here on this thing, let me just move my cursor around here and get the drawing tool back up for you guys. You can see here, right there, right there, right there, and now right there. And every time we've had a little bit of a capitulation. However, NASDAQ to me just looks a little bit more bearish than the other indexes. It's telling me that, and this is not going to be a very straight line, right? But you can see that rising wedge there, okay? And the break of that typically is to the downside. So if I was anything, I would be more willing to short in Q or the Qs rather than playing it long. Okay, now we do get Apple's earnings next week, but the high valuations are forcing these tech companies to raise the bar on their earnings. And even though they're doing outstanding earnings and year over year growth is north of 25 to 45%, depending on which number you look at, very strong, they don't justify some of the valuations that are placed on it. So that's kind of what we're seeing. So I'm looking at this in NASDAQ, and I would be more willing to look at NASDAQ pulling back a little bit more than the others. And then the one that got hurt the most, which also was the strongest this week, is the Dow. Now you can see the Dow here it's in its R1 zone finally. Okay, so remember all the others, the S&P were in and then busted north of the R1 zone. But right here for the Dow, here's the R1 zone. We were there for a couple of days. We just could not get up into it right there, and now we're sitting smack dab in it right there. Okay. So, and there is really no divergences in the Dow that would suggest any pullback here is going to be a buy the dip moment. We'll come back in here. If we can get enough energy to escape velocity to clear it, then 25,808 at that prior peak right there. Pivot high is going to take us up into that level right there, and then we'll just see where we want to go. The Dow was driven more by trade tariff issues than, say, the S&P. It is not as strongly correlated to it. Any good news out of the trade tariff issue, generally the Dow is going to move higher. In fact, on the Dow, at market close, when we heard on Wednesday what Juncker and Trump were doing, I was getting into Dow futures as soon as it hit the market that's what they were agreeing to, and then the Dow moved up an additional couple hundred points. So that was a low fruit hanging kind of play short term. But you can see where we're sitting with the Dow. Now, the one thing that I'm also watching when I'm thinking about the Dow is the Dow transports. You can see here that we had two candles, and this would just show the strength and the ability of the transports to completely reverse. We had a textbook bearish engulfing pattern candle right there. You can see that red candle right there really engulfed that candle and that candle right there. So two candles. That was bearish engulfing. That was bearish as you could be. Now it's a daily chart. You can see the 50 EMA. But then we had the very next day, it totally reversed and came back up here, and then another high up there. So that is very bullish for the Dow transports. The 50 EMA held up very nicely and it moved back up. And of course, the MACD moved back above the zero line. And we got the separation between the signal line and the MACD line. So that does suggest we're going to be moving up to this R1 zone up here, just like with the Dow Jones Industrial. We're sitting up in this level here. So, and of key to me is that we move back above the 2018 open price. So we're in the green again. So watch the Dow Jones transports. It could be a really interesting play here. Now there's a stock that I'm going to talk about with our members this Sunday that is going to play into the transport sector, but not how you think. And it could be a real interesting play. It's undervalued right now, so it should be something that we're going to watch and possibly take a position in. So this is what I'm looking at the Dow or the transports. Now, if we look at the Russell, okay, and look at the Russell futures, it had an ugly day on Friday. It was down over almost 40 points, and it actually broached the 50 EMA. So we're going to watch this very closely. You can see this upsloping trend line very close to it. This is what we would call our poor man's bearish divergence. It wasn't a classic bearish divergence, but bearish divergence nonetheless. So that does suggest a little bit of weakening here. I want to see it capture and hold this upsloping trend line. Should it break, then it just shows money is coming out of risk off or risk on trades and moving into risk off trades. If we look at a classic risk off sector, which is staples. All right, this is consumer staples. Going all the way back to May, you can see consumer staples has been making that stealth move to the upside, right? Look at that. And we're sitting here at this key pivot point right there. We're trying to break out of it. I do believe that as we move forward in time, staples is going to start to outperform some of the risk on sectors, right? I mean, if we look at some of these ratio charts, right? And let's say we look at discretionary versus staples right here. Look at this ratio chart here. What this suggests is since June 15th, staples has been outperforming discretionary. And as you guys know, discretionary has been the classic risk on sector for the past 2 or 3 years. And over the past 30 days, money has been going into the staple sector. So this to me suggests money as we go into the latter half of 2018 is slowly starting to pick up risk off types of investments. So we're going to see more and more of this as we move forward in time. And I do believe that this is something we got to keep a very, very close eye on. We had a classic bearish divergence here set up and trigger, and that does suggest that we're going to see more money flow into the staples sector. If we look at just the discretionary sector, XLY, right here, you can see here that we had this classic bearish divergence set up, right? And it triggered back on the 19th of July. So the 20th would have been a signal to go short XLY. And you can see here it's holding up a little bit, but it may give up a few more points. We could pull it back just a little bit, see if we get support at a lower area down here. But that is just kind of showing just a little bit of faint signs that the markets are starting to seek a little bit more of a risk off kind of environment. And then if we look at if we go look at the Vanguard All World Index, you can see here where it's been moving up slowly. So we're starting to see a little bit more strength come into other country indexes. The Vanguard All World is off of its lows, but we're still well below the 2018 open price. And if we look at the tracking stock for China, China is just getting killed with the trade tariff issue, right? You can see the 2018 open price and just how far down we were. The furthest extension from the peak to the trough was 27.98%. That's a long move down. So China, is really in a bear market kind of scenario here, and they're going to follow where we go with the trade tariffs. So that's a little bit about what I'm seeing active there. Volatility wise, well, for the past 2 weeks, volatility is up just a little bit, but you could see here, let me just get the vol chart up for you guys. You can see here how volatility, it's kind of more propensity to move higher rather than lower. And we're getting some of these moves here in the MACD. So that suggests, I think we're getting to a situation where if we have another 2 or 3 days of hard down moves of over 20 S&P points, or 50 NASDAQ points in the futures market, you're going to see vol come back up over 14. Right now, it closed the week at 1303. And it was off of the lows that we had over the past couple of weeks of in the middle 12 area. So we're seeing the VIX slowly just creep up just a little bit. And if we look at the bond market and we look at treasuries, right, and just kind of see how we fared, the bonds were up just a little bit, but that is after that huge down move that we've had this week. So bonds are down for the week. I've been saying every time we move up into this R1 zone up here with bonds, it's a selling opportunity, not a buying opportunity. And we've seen bonds sell off here. A lot of this was attributable, at least in hindsight, mostly to the Japanese policy of still continuing to commit money to their economy. So that is a little bit about where we're sitting right now in the Treasury market. Currency wise, well, the dollar's getting stronger, the gold is getting weaker. This past week, you can see here, the dollar had a very strong day on Thursday, and then it's just consolidating. But we've been in overall net, we've been consolidating for a long period of time in the dollar. We're almost at a value area here going back about 90 days where the dollar is located right now. You can see this 2018 high for the dollar that was made just a few weeks ago. It's just a little bit of a retest of the 50 EMA, but I do believe there's still more upside for the dollar. By the way, the Feds are forecasting, or the markets are forecasting, a rate hike of about 93% with the Feds this week. We get the FOMC meets on Tuesday and Wednesday, then they come out with their interest rate policy. The markets are not expecting an interest rate hike this week, but they are expecting another 25 basis point hike in September. And then there's about a little bit over a 60% chance of an interest rate hike in December. So the markets are now pricing in 2 rate hikes for the year. That's built into the current prices that you see. So we're going to hear from Power Ranger Powell at his press conference this Wednesday. We also get on Thursday, we get the Bank of England and their interest rate policy. And if we look at the British pound, you guys know that after we got outside of this, we played the British pound really nicely off the Brexit. You can see this trend channel here. We were buying at the bottom of the channel, selling at the top of the channel for some time since the Brexit in 2016. And quite frankly, once it was up here, the trade would have been short. We were off the trade, getting ready to put our foot on the accelerator to go long, but the markets just kept falling for the pound, and we never got a long signal. And then once it broke the channel, then we just shifted out of our long stance, and I kind of shifted over to a bearish stance. We're going to get, the forecast, the market is forecasting an interest rate hike for the Bank of England this Thursday, but we will see. Right now it's at 50 basis points. The markets are forecasting a raise it to 75 basis points. We'll see how that works itself out. We're getting some strong bullish divergence here, so that would suggest the pound will bounce next week into the Bank of England's earnings forecast. All right, so we've got a number of central bank activity this week, from Japan to the U.S. to Bank of England. Last week, we also had Super Mario Draghi, where he basically just didn't do anything. They're still spending 30 billion a month in euro stimulus, and he said they're going to leave their interest rates where they are. Interbank lending is still negative all the way out to summer of next year. So that has a tendency to make the euro a little bit weaker, although on Friday it was up just a little bit, but we're just chopping around here. I think the euro is going to come down to my forecasted level of around 114 is what I'm calling for the euro. Still a little bit more downside in that currency there. And then, of course, with a stronger dollar, we get weaker buy or gold, and you can see here the gold futures still continues to track lower. You can see we're just chopping around here, and as I said, any move higher in the gold, I will be looking to short it. We got a little bit of a divergence here on this daily chart on a short-term basis. That does suggest a little bit of a lift, but it's just there's so many people shorting, so much money shorting the gold market right now because of a stronger dollar that I just don't see this thing changing, over the next 6 months. We could chop around. There's going to be some nice trades in gold over the next 6 months as we play this chop to slightly lower. I am also on record as saying gold is going to be back up over 1,300, probably 1,350 in the next year and a half. The minute we get a little bit of a crash in the U.S. markets and we go into a bear market, gold is going to be a place to be a good, interesting play. But not right now. It's not the play right now. Same thing with silver. Energy market, well, what we're seeing in oil is just a lot of geopolitical influence and a lot of volatility. I'm still a believer that oil is going to come down. You can see this trend line here where we've been playing it, dancing around it. I still think oil is still more subject to more downside risk than upside risk. Trump's got tweets out there of releasing anywhere from 5 million to 30 million barrels of oil from the strategic reserves in the U.S. And I can see him coming out with a statement saying we're going to put 500,000 barrels out a month for the next 6 months going into elections. Get gasoline prices down, do it as a political thing, ease up the consumer spending on that. I mean, I could just see that happening. So that would have a tendency to push the price of oil down, regardless of where the charts are showing. So I do believe the risk of a move in the oil market right now is more down than up. If we look at, if we take a look at Brent oil, well, you can see Brent oil broke its trend line and then regained the trend line. And if we look at the difference between Brent and WTI, that is the spread. Up at this level here, we were shorting the spread. In other words, we were going short Brent, we were going long WTI. I got out of it too soon. I think some of our members stayed in for a while. It's $1,000 a point. So it moved, for the spread narrowed from all the way from 1130 all the way down. It actually came down to a low of about 2.4. The average spread over the past 5 years has been around 5, and that's exactly where we reverted back to, right to that mean right there. So flip a coin. I think the yield or the spread difference is going to widen again. Because I think the propensity for WTI to go down is greater than the propensity for Brent to go down. There's more geopolitical risk around Iran, the Straits of Hormuz, and what Saudi Arabia is doing in Yemen. There's just in Libya, there's a lot of that, and all of that is related to Brent, not WTI. WTI, I think the risk, as I said, is more downside. So that would have a tendency to widen this spread here. So it could be a really interesting trade. Meanwhile, in the ag market, well, what can I say? Our members know the trade we got going on in the ag market, but you can see corn having fallen out of bed is bouncing back up a little bit, and soybeans having fallen out of bed and bouncing back up is performing as we said. For our members that are taking the trade that we're doing, it's shaping up to be a pretty interesting play. We've got some other trades going on in emerging markets. If you look at emerging markets right now and just kind of see what it's doing, you can see how it is also bouncing up along with the Vanguard All World Index. We're still well below the 2018 price, but you can see how it's bouncing up here. So there's some trades in that we're currently playing. So I just think the markets in the second half of this year are going to be very interesting. I still think we're going to have a couple of shots across the bow or some volatility pops, so we got to be very careful. Members, this Sunday evening, we'll go through some new interesting trades as well as some of the ones that we got currently in play right now. Otherwise, have a great weekend, everybody. And if you're not a member of our group, highly encourage you to come in and check us out. We're doing really well this year, and I think the 2019 year is going to be even more amazing than 2018 with some of the things that are going to be popping up. Have a great weekend, everybody. Members, I'll see you this Sunday night. Take care now. Ciao.